Don't buy an annuity until you watch this video. There's no shortage of opinions when it comes to annuities. Some advisors love them, others hate them. The truth is, though, it depends. Some annuities can protect your future, others are just overpriced insurance contracts with layers of hidden fees and confusing fine print. So in this video, I want to break down the major types: fixed, variable, and indexed, and show you the pros and cons and the red flags of each and what you need to know before you buy. And this isn't me bashing annuities. In fact, many of my clients have annuities, but it has to make sense for them and it has to be in their best interest. And that's what makes the most sense, is something that's in your best interest. So before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make the most of their money. Let's jump into the video. Let's begin with something that most people misunderstand. There's no such thing as just an annuity. The word annuity simply describes a financial contract between an investor and an insurance company. But there are many different types of annuities out there, and they each behave differently. So let's start with the basics. The first is the fixed annuity. This is very similar to a bank CD. What the insurance company promises here is to pay you a certain percentage on your money over a fixed period of time. So they might guarantee you something like 4% interest a year over a 7-year period. And when that 7-year period's up, they'll pay you something called a guaranteed minimum interest rate. Typically, it's like 1% or 2%. So when your contract is up, you have a couple of decisions you can make with your money. You can leave it there and you can earn a very low 1 or 2% interest rate. You can move it to another annuity via a 1035 exchange, in which you can re-up into another fixed annuity or another type of annuity and not create a taxable event. You could pull the money out and spend it, or you can position it into some other type of investment, whether it's an annuity itself or investments in mutual funds, stocks, bonds, things like that. So the pros of the fixed annuity is it's simple and it's safe. The con here is that the rates don't often keep pace with inflation. So over time, your purchasing power will erode. And if you need to access all or a big portion of the funds early, you're likely to pay a surrender charge. So it's just something to be aware of. The next annuity we're going to talk about is the variable annuity, and that's on the opposite ends of the spectrum compared to the fixed annuity. These let you invest in sub-accounts, which are basically just mutual funds, and your returns will fluctuate with the market based off of how those underlying sub-accounts perform. They also often come with riders and guarantees that provide a minimum income or death benefit. But there's a catch. Variable annuities are among the most expensive financial products out there. You might be paying 2 to 3% a year in combined fees, sometimes more. And while you do get market upside, you're still exposed to market losses. In many cases, clients think they're buying safety, but they're really just buying an expensive tax-deferred investment account with far less flexibility. Now, the third type of annuity is the one I get asked about the most. That's the fixed index annuity. Index annuities are built to offer a middle ground between the fixed annuity and the variable annuity. Your returns are tied to a market index like the S&P 500, but you're not explicitly invested in the market. If the index goes up, you participate in a portion of that gain, usually up to a specified cap or a participation rate. And if the market goes down, you don't lose your money. Your account just stays flat. So for example, let's say your contract has a 10% cap. If the S&P 500 goes up 12%, you would be capped at 10%. If it goes up 6%, you might get 6%. Now, on the flip side, if you had a participation rate index annuity, let's say your participation rate was 80% of the S&P 500, and the S&P 500 is up 20%, you would get 80% of that 20% return, or 16%. Now, where these are advantageous is if the market goes down. So if we think back to 2022, which was the last down year we had, the market was down about 15 to 20%, depending on the index you followed. You wouldn't lose a single dollar, even though the index itself went down, because that's the guarantee that they're making you with the fixed index annuity. So you don't lose anything in that scenario, regardless of whether it's a participation rate or a cap. That combination of downside protection with some market-linked upside is appealing to a lot of people, especially those nearing retirement who want to still earn a little bit more than what a fixed annuity would pay, but don't want to take all the risk of investing 100% of their money in the market via a variable annuity or just regular mutual funds or stock-based account. But even index annuities come with trade-offs. And that's where we need to talk about the drawbacks of each of the different types of annuities. The first drawback we're going to talk about is the surrender period. And most annuities come with surrender charges, meaning your money is locked up for a period of time, somewhere between 3 and 10 years. And during that period, you can only withdraw what's called your free corridor amount, which is typically around 10% of the contract value. And you can do that without incurring that penalty. Anything above that free corridor amount, you're going to be assessed a surrender charge. So if you need to access more for a medical emergency, helping a family member, or even just changing your mind, you could face steep fees. This is a big reason why we recommend never putting all of your liquid assets into an annuity, because flexibility matters. Now, some annuities do allow for special provisions where you can pull out money without incurring penalty for medical expenses or long-term care costs, but you are likely to pay a higher fee on those types of contracts. But most contracts are going to charge you a fee as high as 7% or more to do an early distribution from your account. That's why it's important to know your free corridor amount. That's the amount, again, that you can take penalty-free each year, and map out your cash flows in order to make sure you can hold this investment for its intended duration. The last thing you want to do is to pay a fee on money that you've invested in a contract that's supposed to pay you. The next drawback we're going to talk about are the fees and complexity of annuities in general. Some annuities, especially variable and income-focused indexed annuities, come with layers of fees. You might be paying for something like an income rider or a death benefit rider, and the management costs of the sub-accounts on top of that. I've seen some clients unknowingly pay in excess of 3% per year on contracts that were supposed to be safe. That's why understanding the net return after fees is critical. And there's a bunch of jargon when it comes to fees. The first is the mortality and expense ratio fee, which often is referred to as the M&E fee. And this is the percentage charged on the asset's fair market value of the initial contribution each year. I've seen these range from 0.5% on the low end to upwards of 1.5% on the high end. So let's just assume an investor with $1 million is paying a 1% M&E fee. They're paying $10,000 a year just for this one fee. And it's not the only thing that they're going to pay. There also might be something like a rider attached to this contract. And riders typically guarantee one of two things: lifetime income or an enhanced death benefit. So these will guarantee you, on the income side, this will guarantee you a benefit growth rate or a specified payout for life, and it's going to be guaranteed. Or it's going to guarantee a step up in your death benefit should you pass away prematurely and not utilize the funds within the annuity, so your beneficiaries get a little bit more on top of what you put in. So I've seen these average somewhere between 0.25 to 1.5%, but often they float around 0.5% each year. So that same investor with the 1% M&E fee might also be paying an average of 0.5% for a rider fee on top of that, or another $5,000 a year. So these are just two of the fees. There's more that we need to account for. The next type of fee that we need to account for is the sub-account fee, and that typically only comes with variable annuity. And sub-accounts are just what you invest in, so the underlying mutual funds that help that account go up and down in value. And the fees on these types of investments range from 0.1% on the low side to upwards of 1% on the high side. Typically, what I find is that investors pay an average of 0.3% in sub-account fees each year on their annuity investments. So that same $1 million investor has another $3,000 a year fee from the sub-accounts. So if we add up what the average person will pay in a variable annuity, it's 1% for the M&E fee, 0.5% for a rider fee, 0.3% for the sub-account fee. So they're paying about $18,000 for a $1 million annuity investment. And truthfully, that's a little bit on the low side. I've seen these upwards of 2.5%, 3%. So if you compare that to something like a ETF only or stock only portfolio where an advisor charges 1%, that same $1 million, your fee could be as low as $10,000 or even less if the advisor charges a lower AUM fee. Just something to be cognizant of. But the fees don't make this a bad investment, just something to be aware of and that you need to make sure are offset by the advantages and the benefits that the contract provides. Fees aren't inherently bad unless there's not value. So as long as your annuity contract is providing you value in excess of the fees, have at it. Keep investing in it. If it's not, it's time to question the approach and figure out whether an annuity or a different annuity is a better investment for you. The third drawback that we see with annuities is there's no inflation protection. While some annuities offer income for life, that income is usually fixed, meaning it doesn't grow with inflation. So $3,000 per month today might feel really great. 15 years from now, it's probably not going to feel quite as great, and it's not going to be worth as much money. And that can be a major problem if you're using an annuity to cover your core living expenses in retirement. Or if you're investing in a fixed annuity that offers a fixed rate and inflation takes off similar to what we saw a few years ago. We want to make sure that we're accounting for our after inflation returns when it comes to investing in annuities, because that is what's going to our bottom line. That's the real return that we're getting on our investment. So another drawback we want to talk about are the tax implications. And this one's very subtle, but it's also very important. If you buy an annuity inside of a traditional IRA or other pre-tax retirement account, all distributions will be taxed as ordinary income. And that's not unusual. That's how most pre-tax retirement accounts work. But here's the issue. Annuity income also counts towards something called provisional income, which can cause up to 85% of your Social Security benefit to be taxable. This is where advanced strategies like gradual Roth conversions or using Roth annuities come into play. If you can reposition some of your assets into tax-free vehicles while rates are still low, you might save thousands in taxes down the road. You also want to be aware of something called the exclusion ratio if you buy an annuity that's considered non-qualified, which is just a fancy way of saying you bought an annuity outside of a retirement account. The exclusion ratio is the amount of your annual income payment that is excluded from your income when it comes to the annuity payments. Since annuities are by their nature payments you receive on your own money, part of those payments are a return of your capital, while the other is part interest, similar to how when you pay your mortgage each month, part of it goes towards principal, the other part of it goes towards your interest. So if your monthly payment from your annuity is $2,000 and your exclusion ratio is 40%, $800 of that payment is not taxable, while the other $1,200 is taxable at ordinary income tax rates. This is really important as you start thinking about income tax brackets in retirement or just in general to make sure you're not tipping yourself into a higher income tax bracket, which could then lead to higher capital gains tax rates and net investment income tax implications and a myriad of other types of tax implications that we're not going to cover in this video, but that need to be considered with annuity payments. So now it's time for the big question, and that's, should you ever buy an annuity? And the answer is sometimes you should. If you've run the numbers and you know that you'll have an income gap in retirement, meaning that your Social Security, any pensions, any investments you have aren't enough to cover your monthly needs, then a properly structured annuity can be a great tool. But it has to be the right type of annuity and it has to match your goals. For example, some clients want the highest guaranteed income possible. In that case, we might look to an income-focused indexed annuity or a variable annuity with an income rider, something that'll give you a lifetime paycheck for each month for as long as you live. Other clients want safe growth without market volatility. In that case, we looked at an indexed annuity or a fixed annuity with no annual fees, something that allows your principal to grow in flatter up markets without going backwards. But even in those cases, the annuity is rarely the whole plan. In most cases, the best strategy is a blend of an annuity with some other type of market-focused investments. You use annuities to cover your baseline income needs or to cover your safety bucket if you're a little bit more of a risk-averse investor, and you use your investment portfolio for long-term growth and flexibility. That way you get downside protection, consistent income, and the potential for growth without putting all of your eggs in one basket. And that's a balanced financial plan. So how do advisors get paid for annuities? And this is the big elephant in the room. And it leads to a lot of bad annuity sales. And frankly, it's very concerning as an advisor seeing other advisors push annuities because they get paid a little bit more for them. So most advisors will earn a commission when they sell an annuity, and the commission can be as high as 7%. So in the example where you put $1 million of your money into an annuity, your advisor's earning $70,000 on that sale, and you're stuck paying somewhere around 2% a year on that annuity and fees, or roughly $20,000 a year. And most advisors who sell annuities for commissions are only subject to the suitability standard, not the fiduciary standard, which means the recommendation must make sense, but does not have to be in your best interest. So the sale can be justified as appropriate, but it does not have to be what's optimal for you. Now, if you have sufficient income, don't need to worry about having an enhanced death benefit, or aren't extremely conservative and your advisor is still pushing an annuity, ask yourself if this is the best investment for you. If it does not feel like it is, your advisor is probably thinking about their commission and not your best interest. Now, with all of that said, there are some annuities that advisors can offer as fee-only annuities, meaning you pay a percentage of assets under management fee on them, and you pay it directly to the advisor, so there's no commission. The AUM fee is typically around 1% or less. There's a reduced potential for conflict of interest, and many of the advisors with these types of options are fiduciaries, which means they recommend these solutions because they make the most sense for you. So to wrap this up, here's what I recommend if you're considering an annuity. The first is to know your income gap. Don't buy an annuity unless you're solving a real problem. Second is to compare multiple contracts. Don't just buy what a salesperson pushes, especially if they work for an insurance company. You don't want someone who pushes proprietary products only. If you need to buy an annuity, compare multiple contracts across multiple different carriers or insurance companies. Third is you want to understand the fees, caps, and surrender terms. Every annuity is different. It's important to know the pros and cons of each that you're considering. You also want to think about taxes. The account type matters, and the timing of distributions does as well. How is it going to play into not only your tax picture today, but your tax picture 5, 10, 20 years down the line? You also want to work with a fiduciary. You want someone who's legally obligated to act in your best interest, not someone tied to a single product or commission. At NavWealth Partners, this is exactly what we do. We walk you through your full financial plan, not just the product, and help you understand if an annuity is even necessary, and if so, how to structure it for the maximum flexibility and tax efficiency. If you want help evaluating your options or understanding how an annuity might fit into your plan, feel free to reach out. You don't have to navigate this alone. Thanks for watching, and as always, make smart money decisions.